Okay, we are recording. Hi there, everybody. I am doing this recorded lecture for Chapter 9 of our textbook. And in Chapter 9, we're getting into additional valuation issues. And we did talk about this a little bit in Chapter 8 because we talked about the cost flow assumption methods, FIFO, LIFO, the weighted average method. But now again, in Chapter 9, we're getting into additional inventory methods that have to do with how we handle markdowns or declines in inventory value from obsolescence or spoilage or inventory shrinkage. So things like that. So that's what we're getting into in Chapter 9. And again, we're going to go through the PowerPoint slides, and then I have several exercises for us to do together, picked out for us to do together in class. So I'm going to share my screen with you, and we're going to go over this together. So these are the Chapter 9 PowerPoints, and I can't remember if I've posted these in ALNet or not, but I'll make sure when I post this recorded lecture that I also post the Chapter 9 PowerPoints if they are not in there yet. And so again, what we're looking at in Chapter 9, understanding lower of cost or net realizable value, LCNRV, applying and understanding lower of cost or market, LCM, understanding some of the other inventory valuation issues, determining ending inventory by using the gross profit method, the retail inventory method, and then some of the ways that we can analyze inventory with the inventory turnover, for example, days sales and inventory ratios, and then how different things like that are reported for inventory. So that's what we're looking at. Okay, so net realizable value, when we think of inventory, because we have talked about net realizable value before, but up to this point, when we've talked about net realizable value, it has been related to accounts receivable, right? So remember, with accounts receivable, net realizable value is the original, what we're owed, the total balance in accounts receivable, less the allowance for doubtful accounts. And so we've talked about that net realizable value in relation to accounts receivable before. But now when we're talking about net realizable value as it relates to inventory, net realizable value is the selling price of the inventory less any predictable cost of completion, disposal, or transportation. So in this example, it's showing us how we calculate that net realizable value for inventory. It says, assume that Mander Corporation has unfinished inventory with a cost of $950 and a sales value of $1,000. Estimated cost of completion of $50 and an estimated selling cost of $200. Mander's net realizable value is computed as follows. So again, we have the sales value, what we expect to be able to sell the inventory for, less the estimated cost of completion, the estimated cost to sell. That gives us that net realizable value. And so, thinking of the net realizable value versus its cost. So remember, it says, assume that Mander Corporation has unfinished inventory with a cost of $950. So if we have a cost of $950 and then we've computed net realizable value of $750, we have a $200 difference there then, right? That $200 is what essentially is the loss on the inventory, or the decrease in value on the inventory. And so just like it shows here, using the lower of cost or net realizable value, LCNRV is the acronym used for that, we would report a loss due to decline in inventory of 200. Right? Because again, it told us that it had a cost of $950. Net realizable value is $750. So then we would report a loss due to decline in inventory to net realizable value. And the way that this may be disclosed within a financial statement, they show us an example here. Inventories are stated at the lower of cost or net realizable value. Cost is determined by using the weighted average method. Net realizable value represents the estimated selling price in the ordinary course of business, less applicable variable selling expenses. So again, we would record the inventory at the lower of cost or net realizable value. In this case, we'd want inventory reported at 750 because that's the lower of the cost or net realizable value, right? That's the net realizable value. It's lower than the cost. So we'd report that inventory at 750, and then we'd have to report a loss due to the decline in inventory. All right, so here's another example that your book shows us. Again, looking at the lower of cost or net realizable value, we're computing or calculating the difference between cost and net realizable value. And again, net realizable value being the selling price less any cost for completion or any other selling cost of disposal, cost of transportation, things like that. So in this example, they're showing us, okay, spinach has a cost of 80,000, a net realizable value of 120. So we're going to use the inventory value of the spinach 80,000 because the cost is lower. So we're going to report it at the lower of cost or net realizable value, right? So we're going to report it at cost. Carrots have a cost of 100,000. That's also their net realizable value. So that's how they're reported. Cut beans have a cost of 50,000, net realizable value of 40,000. So again, we're going to use the 40, the lower of cost or net realizable value. Peas have a cost of 90, net realizable value of 72. So again, we're going to report them at 72. And then mixed vegetables, cost of 95, net realizable value of 92. So again, we're going to report them at 92. So whichever figure, whichever number is the lower of cost and net realizable value, whichever is lower between those two numbers is which one we're going to use, right? The lower of cost or net realizable value. All right, so then this shows us an example of the journal entries that we would do to record this decline in value or decrease in value. And there's two different methods. And as we click through the PowerPoint, they show us both how these methods, how they're presented differently on the income statement and then how they are presented differently on the balance sheet. So we'll see examples as we continue through. But based on this data, if we have ending inventory that has a cost of 82,000, and then we've calculated net realizable value is 70,000, then we need to make an adjustment to basically take inventory down to net realizable value, right? And so if we use the loss method, then we debit loss due to decline in inventory, we credit inventory, right? Loss ends up showing up on the income statement under the other expenses or losses section, right? Or if we use the cost of goods sold method, then we're debiting cost of goods sold instead, crediting inventory. So in both of them, we're crediting inventory, we're reducing inventory. The difference is the debit between the loss and cost of goods sold method. And so like your book tells us, the loss method is usually preferable because then it isolates that number. It isolates the number or the amount of loss due to decline in inventory. Whereas if it's debited to cost of goods sold, it's just kind of included in that cost of goods sold account. It doesn't show it separately. So that's kind of what your book says about it. But both methods are acceptable. All right, so the use of an allowance, when we are using the net realizable value, or calculating down to net realizable value, adjusting, maybe I should say is a better word, inventory down to net realizable value. Like it shows here, instead of directly crediting the inventory account for market adjustments, companies can use an allowance account, and usually they would call that the allowance to reduce inventory to net realizable value. Um, and the way this allowance account it would be set up is similar to the way we use the allowance for doubtful accounts. So remember, the allowance for doubtful accounts, when we're talking about accounts receivable, we adjust that allowance for doubtful accounts every year. So, you know, one year we might want a balance of 10,000 in there, for example. And then the next year, you know, maybe we want a $12,000 balance. So we've got to make a $2,000 adjustment type thing, right? But that allowance account, it, you know, continues to be open. We just make adjustments as necessary at the end of the year or the end of the accounting period, right? So this allowance account would be a contra asset account to inventory. So it would reduce the inventory account. So it says, using an allowance account under the loss method, Ricardo Company makes the following entry to record the inventory write down to net realizable value. So we would, instead of debiting the loss, crediting inventory, we would debit the loss, credit the allowance to reduce inventory to net realizable value. And again, if we get to the next, you know, the end of the next year, the end of the next accounting period, and maybe we need, you know, we need that allowance to be 15,000, right? Then we would just have to do the adjusting entry for 3,000, for example, right? So that balance carries forward. We have to consider what's already in there, what we want to be in there type thing, right? All right, so here's an example of the difference in the way that's shown on the balance sheet. Again, with the loss method, we would list the original cost of the inventory, 770,000, less the allowance to reduce inventory to net realizable value. And so, you know, the overall effect here, 770 minus 12,000, 758,000 is what the inventory would be, right? But we just use this contra asset account. Whereas under the cost of goods sold method, it would be, you know, a debit to cost of goods sold, credit to inventory. So it directly credits inventory instead of the allowance account, basically, is the difference. But we still get the same, you know, total current asset figure either way. It's just a little bit different presentation. And then again, thinking about this income statement, if we used the loss method, we would record the loss under this other revenue and expenses section. And so we'd have the loss there on our income statement. And if we use the cost of goods sold method, because remember here, we would debit the loss, right? Whereas with the cost of goods sold method, we debit cost of goods sold. That increases cost of goods sold up here. So that's the difference. You know, again, we get the same net income figure. It's just a matter of, are we taking it out up here from cost of goods sold or then charging it as a loss type thing, right? Okay, so you know, I mentioned this already, and so they're going to show us like the use of the allowance method over multiple periods. Just like with our allowance for doubtful accounts, we just have to keep making adjustments to this account. So just like it shows here, in general, accountants adjust the allowance account balance at the next year end to agree with the discrepancy between cost and net realizable value at the balance sheet date. So for example, if we had inventory cost of 188,000, inventory at net realizable value was 176,000, then we'd want $12,000 in that allowance account. And we would, you know, debit the loss, credit the allowance, right? And so that has, because we're debiting the loss, that has a decrease on net income. Okay, the next year we've got inventory at cost of 194,000, net realizable value 187,000. So now we want that allowance account to be 7,000. And so because we already have 12,000 in there, we want it down to 7 now. So that's a decrease in the allowance. That increases net income. All right, the next year we want cost to be 173, or excuse me, cost is 173. Net realizable value is 174,000. I guess on this one, amount required in valuation account, maybe I guess because it's so close, they're showing a 0 here. That's strange. I didn't realize that. Next one, inventory cost is 182,000. Net realizable value is 180. So again, we want the valuation account or the allowance account to be 2,000. So that's an increase and a decrease to net income. Okay, anyway, we have one picked out like that we get to do together, where we look at how it would increase and decrease in that valuation account. All right, so lower, so that was lower of cost or net realizable value. The second way that it talks about in this book is lower cost of market, or LCM is how it's shown as an acronym. And it says the use of the lower of cost or net realizable value method works well to measure the decline in value of a company's inventory. For most companies, it said the Financial Accounting Standards Board, or FASB, decided to grant an exception to the lower cost net realizable value approach for companies that use LIFO or retail inventory methods. So the exception is this lower of cost or market. So rather than comparing cost to net realizable value under this alternative approach, companies compare a designated market value of the inventory to cost. And again, we call this the lower of cost or market. And so we're going to see, similar to the net realizable value approach, we're going to select, a number that's in the middle of this ceiling and this floor that we're going to get practice calculating and talk about. But what we do with the lower cost to market, again, we compute the net realizable value, which is used as the top number, the ceiling. And then we compute net realizable value less the normal profit margin, and that gives us the floor. And again, that market valuation is generally in the middle of those two, in the middle of the ceiling and the floor. And just like we said before, net realizable value, that's the estimated selling price less any reasonably predictable cost of completion and disposal, transportation, those variable selling expenses, right? All right, so then let's look at an example of this. And it says here, a company values inventory at lower of cost or market, with market limited to an amount that is not more than net realizable value or less than net realizable value, less that normal profit margin. All right, so here's our example of that. It says, assume that Parker Corporation has unfinished inventory with a sales value of 1,000, estimated cost of completion and disposal of 300, and a normal profit margin of 10% of sales. Parker determines the following net realizable value. So again, we take that inventory less the estimated cost of completion and disposal, 300. And so that gives us that net realizable value of 700. And then we subtract the normal profit margin percentage. So if normal profit margin is 10% of sales, 1,000 times 10%, we're going to subtract another 100. And that gives us net realizable value less a normal profit margin. So just like it tells us in our book, the reason why we use these or calculate these ceiling and these floor limitations is that the ceiling, which is net realizable value, right? If that's our ceiling, that's the highest value basically that we're going to use. That allows us to prevent overstatement of the value of obsolete, damaged, or basically inventories that are have either become obsolete, have become damaged, or have lost their value, right? Where when we calculate the floor, which is the net realizable value less that normal profit margin, and we won't go below that floor, then that deters us from understating our inventory, right? Okay, so here's an example of that. And so this one says, and we looked at an example similar to this when we were looking at the lower of cost or net realizable value. So in this example on spinach, okay, if we have a cost of 80,000 and we're between, replacement cost of 88,000, net realizable value, the ceiling is 120,000, net realizable value less the normal profit margin is 104,000. Designated market value 104,000, again lower of cost or market, so then we're going to use the cost, right? The lower of cost or market. And so on this one, and I was trying to see where it says, right. So it says the designated, and this is on page 449. It says the designated market value is the amount that the company compares to cost. It is always the middle value of three amounts. So the three amounts: replacement cost, net realizable value, and net realizable value less the normal profit margin. So essentially, it's between replacement cost, net realizable value, which is the ceiling, and then net realizable value less the normal profit margin, which is the floor, right? So that's how we get that designated market value, the middle of these three numbers, essentially, right? And then we look at the lower of cost or that designated market value, right? Whichever one is lower, right? And that's what they show us on page 449. Okay. So then now we're looking at, okay, carrots, replacement cost 90,000, and then we get that ceiling 100,000, the floor 70,000. Again, for that, in this case, we're going to choose to use that 90,000 because that is the lower of cost or designated market value, right? The cut beans, it looks like we've got cost of 50,000, replacement cost of 45. The ceiling is 40,000, the floor 27,500. So we're using the lower of cost or designated market value, and again, that's 40,000 in this case, right? All right, the peas, what do we got? Cost of 90,000, replacement cost 36, net realizable value, that ceiling is 72. The floor is 48, gives us that designated market value of 48,000. We're using either cost or lower of cost or market, so we're going to use that 48. And then same thing with the mixed vegetables, right? So we've got a cost of 95,000. But again, if we look at replacement cost, the ceiling and the floor, we're designating that market value of 92,000. We're going to use that for our final inventory value. So the adjusting entry, again, to record this difference in cost and market, right? The lower of cost or market is a debit to loss due to decline in inventory to market, and then the allowance to reduce inventory to market. And so remember when we were using an allowance under the net realizable value, then our journal entry would be, loss due to decline in inventory to NRV, right? When we were looking at that journal entry. And then when we were looking at the journal entry for the allowance method, we said credit the allowance to reduce inventory to net realizable value, right? So when we're talking about this lower of cost or market, then it's replaced, you know, that verbiage or the wording is replaced by market as opposed to net realizable value. All right, so some of the areas of concern with you know, choosing lower of cost net realizable value of or lower of cost or market rules is that there are some conceptual deficiencies. So the first one that your book talks about, the expense is recorded when loss in the utility occurs or loss in the value of inventory occurs. Profit on the sale is not recognized until the actual sale. So those are not recorded necessarily in the same period, right? So this is inconsistent treatment. Usually with that matching principle, we want to match expenses with the period of revenues, or we want to match revenues with the expenses incurred to generate those revenues, right? So then this is inconsistent treatment that way. The inventory is valued at cost in 1 year, and then at market could be valued at market in the next year. So again, that, you know, that because, you know, consistency principle, you know, says that we want to choose the same valuation methods year over year. So again, the, you know, we're applying these rules inconsistently, right? The third reason it talks about net income in year of loss is lower. Whereas when we sell the goods, if we don't actually sell the inventory for that lower value that we thought, that could result in higher, you know, higher net income in subsequent periods. And then application of these rules uses a normal profit in determining inventory values, which is a subjective measure, again, because it says that since companies develop these estimates based on past experience, this subjective measure presents an opportunity for income manipulation. So it's something, again, it's something that's an estimate, and it doesn't always, it's not always correct, right? All right, so valuation at net realizable value, again, like it shows here, it is permitted by GAAP. If it is a controlled market with a quoted price applicable to all quantities, there are no significant cost of disposal, or it's too difficult to obtain cost figures. All right, so using valuation using the relative sales value on lump sum purchases. So, you know, this is kind of like a vertical analysis, and we've looked at a little bit of this type of vertical calculation in cost and managerial accounting already. But basically what we're going to be doing is we're going to be looking at the overall sales and then breaking down those sales into the different categories which they represent, if that makes sense. But we're going to see an example of it. So it says Woodland Developers purchases land for 1 million that it will subdivide into 400 lots. So again, we're looking at how to allocate this $1 million cost between these 400 lots, right? And so it says these lots are of different sizes and shapes, but can be roughly sorted into 3 groups, graded Group A, Group B, Group C. As Woodland sells the lots, it apportions the purchase cost of 1 million among the lots sold and the lots remaining on hand. Calculate the cost of lots sold and gross profit. So if we're looking at, you know, again, we've got total sales price, and we had what, two, oh, okay. Total cost was 1 million, right? And we've got these 400 lots. And so we're looking at what do these lots, because remember, some of them are A lots, some of them are B lots, some of them are C lots. So the A lot, we're going to sell for 10,000 per lot. The B lots, we're selling for 6,000 per lot. The C lots, we're selling for 4,500 per lot, right? So if we take our, 100 times 10,000, that's 1 million is what we're selling those for. We take B 100 times 6,000, we're selling these for 600,000. We take C 200 lots times 4,500, we're selling those for 900,000. So it's going to be a total of 2.5 million in sales. And then we're looking at what does each one of these categories take up of the whole. So the $1 million in sales divided by 2.5 million. The 600,000 in sales divided by 2.5 million. The 900,000 in sales divided by 2.5 million, right? And that's what they're showing us here. So if we're thinking about the million in sales divided by the 2.5 million overall, and we take that fraction and multiply it by the total cost, and that determines how much we're allocating to lots A, right? Lots B, 100 lots, we're selling them for 6,000 each. That's 600,000 in sales of our 2.5 million. So 60 divided by 250 is that fraction, times 1 million, we're allocating 240,000 of the cost to the B lots. The C lots, again, there are 200 of them. We're selling them for 4,500 each. And that's 900,000 in sales. 900,000 divided by 2.5 million. That's our fraction. We're multiplying by the cost. So we're going to allocate 360,000 to those lots. So then to get the cost per lot, we're just taking the cost allocated to the lots divided by the number of lots. The cost allocated to the lots divided by the number of lots. The cost allocated to the lots divided by the number of lots, right? That gives us the cost per lot. And so if we look at how many, oh, hot dog. If we look at how many of them we sold, each that we sold, we can, multiply by that cost per lot to get the total cost of lots sold. And then we multiply it by what we're selling them for to get the total sales dollars. So sales minus cost of lots sold equals gross profit, right? We've done that calculation together before. All right, so another thing that your book talks about are purchase commitments. And so on these purchase commitments, it's referring to commitments or contracts where the seller retains title to the merchandise. So the buyer does not recognize any asset or liability on the purchase. If it's material, the buyer should disclose the contract details or in the notes to the financial statements. And then as it shows here, if the contract price is greater than the market price and the buyer expects that losses will occur when the purchase is affected, the buyer should recognize losses in the period during which such declines in market prices take place. So this is where we're going to end up using that unrealized gains or losses account that we've talked about together before. So here's an example of that. It says St. Regis Paper Company signed timber cutting contracts to be executed in 2018 at a price of $10 million. Assume further that the market price of the timber cutting rights on December 31st, 2017 dropped to 7 million. So we've signed a contract for 10 million, but now the cutting rights, the price of the cutting rights have dropped to 7 million. So to record this, we would debit that unrealized holding gain or loss since we're since we're debiting it, essentially we're debiting unrealized holding loss, right? If it was a gain, we would be crediting unrealized holding gain or loss, right? Because revenue or a gain is credited, expenses or losses are debited, right? So we're debiting unrealized holding gain or loss and then crediting estimated liability on the purchase commitment. And just as it shows here, and hopefully we know this already, unrealized holding gains or losses show up under the other expenses and losses on the income statement. Estimated liability on the purchase commitment would show up in the liability section on the balance sheet. So it says when St. Regis cuts the timber at a cost of 10 million, it would make the following entry. So we would debit purchases or inventory for 7 million, debit the estimated liability on purchase commitment, credit cash 10 million. And then in the next part of this, it says, assume the Congress permitted St. Regis to reduce its contract price and therefore its commitment by 1 million. So instead of having an unrealized holding gain or loss of 3 million in total, we would reduce the liability, we would reduce the loss. So debit the liability by 1 million, which again reduces that liability. Credit unrealized holding gain or loss, which then reduces that loss down to 2 million. All right, gross profit method for estimating inventory. And so we're going to talk about the gross profit method, the retail inventory method. But just like your book tells us, this is a way for companies to value their inventory without a physical count. So, kind of interim periods, monthly periods or quarterly periods to value their inventory without actually doing a physical count. So it says these are substitute measures to approximate inventory. Beginning inventory plus purchases equals total goods to be accounted for. Goods not sold must be on hand. The sales reduced to cost deducted from the sum of the opening inventory plus purchases equal ending inventory. And so here's our example of this. It says Cetus Corp has a beginning inventory of 60,000 and purchases of 200,000, both at cost. Sales at selling price amounted to 280,000. The gross profit on selling price is 30%. Cetus applies the gross margin method as follows. So goods available for sale, right? Goods available for sale at cost are 260,000. And then sales at the selling price, 280,000. Gross profit, 30%. So we take that 30% of 280,000, which equals 84. So we're taking 280 minus 84, gives us our sales at cost, right? That's the selling price less that gross profit percentage. And then that gives us the approximate inventory at cost. So again, I have one or two of these picked out for us to get practice with. The math's not too difficult on them. We're just basically, because we've got those, goods available at cost, we're reducing selling price to cost as well. And we reduce selling price to cost by taking that selling price less the gross profit percentage. All right, so computing that gross profit percentage, and just like it shows on here, in the previous example, the gross profit was given, but how did we get to that figure? So we compute gross profit percentage just like it shows here. So if something sells for $20 and it has a cost of 15, the way that we calculate that gross profit percentage is by taking that markup, that difference of $5, that gross profit of $5 divided by the selling price. And so that's a 25% gross profit percentage, right? All right. All right, and then this is just showing us a couple other ways to calculate this, depending on what they're asking us for. Again, we'll get practice doing this as we're going through our exercises in our book, but it's not too bad if, for example, they give us gross profit on selling price. Then we can take that and plug it into the formula to determine what the percentage markup would be on cost, right? Or if they give us the percentage markup on cost, we can plug that into the formula and determine what that would be gross profit on the selling price, right? So, both of these, gross profit on selling price, percentage markup on cost, will get percentage or practice rather calculating together. Okay, the using this, and this is just again showing us another example of calculating these gross profit amounts. So it says a stair company uses the gross profit method to estimate inventory for monthly reporting purposes. Presented below is information for the month of May. So as of May 1st, we had 160,000 in inventory. We purchased 640,000 more worth of inventory. So then we had what? 800,000 worth of inventory. Remember, freight in, that increases inventory. So what would be up to 830,000. And then purchase discounts reduce inventory. So then what? We were up to 830 minus 12. Oh gosh, I'm trying to do this in my head. What would we be at? 818 or something like that would be our inventory at that point. So it says compute the estimated inventory at May 31st, assuming that the gross profit is 25% of sales. And then for letter B, compute the estimated inventory at May 31, assuming that the gross profit is 25% of cost. So for letter A, computing the estimated inventory at May 31st, assuming that gross profit's 25% of sales. So goods available at cost, again, 818. And then if we think about our selling price, so remember we got a selling price of 1 million or sales dollars of $1 million, less sales returns and allowances gives us net sales of 930,000. 930,000 times that 25% gross profit percentage, less gross profit 232,500, which gives us sales at cost 697,500. So again, the difference between the goods available for sale at cost, sales at cost, is what our approximate ending inventory would be. Okay. Now, if we calculate it based on a percentage of cost, rather, here in letter B. So to get, it says compute the estimated inventory at May 31, assuming that the gross profit is 25% of cost. So again, if they give us gross profit as a percentage of cost, we want to convert that to a percentage of sales. And then we would calculate it the same way that we just did. Net sales less gross profit as a percentage of sales. All right. So with the gross profit method, again, it has advantages and disadvantages. Companies use it to calculate ending inventory, or rather estimate ending inventory in interim periods when no physical inventory is actually taken. And so just like it shows here, it is an estimate. So, it's not an objective number necessarily. It's not an actual number. It is an estimate. Generally relies on past percentages in determining markup. Those don't always hold true in future periods, right? And then just like it shows here, because different products have different gross profit margins, it's hard to just apply kind of a blanket gross profit margin or a blanket gross profit percentage, because different items and different products and goods have different gross margins or profit margins, right? Okay, retail inventory method, again, just like with the gross profit method, this is a method used by retailers to value inventory without a physical count. It requires retailers to keep total cost and retail value of goods purchased, total cost and retail value of goods available for sale, and sales for the period. And so on this example, and I don't know how you pronounce this. Fuku Fuku Inc. Fuku Inc. uses the retail inventory method to estimate ending inventory for its monthly financial statements. The following data pertain to a single department for the month of October. So it says our instructions based on this data: prepare a schedule computing the retail inventory using the conventional method, which is the lower cost or market method, or the cost method. So again, we'll get practice looking at both of these. For the conventional method, we're comparing the cost of goods available for sale at cost, right? And then at retail, and calculating that cost to retail percentage. And so if we have ending inventory at retail 96,400 times that cost to retail percentage, then we would expect ending inventory at cost to be $64,588, right? That's less these markdowns and spoilages. And then the cost method, again, we're going to get practice doing it both ways. But, again, we're looking at that goods available for sale in relation to goods available for sale at retail to get that percentage. So ending inventory at cost, we'd expect to be $65,056. All right, some of these special items relating to the retail method that we have to keep in mind, and I know some of these we've dealt with before. Freight cost, of course, we know are part of the purchase cost, and they're added to the cost of inventory, right? Purchase returns are generally same thing with discounts and allowances. Purchase returns, purchase discounts and allowances reduce the purchase overall purchase price. So, if we think about it, if we take the total amount of purchases plus freight cost minus purchase returns minus purchase discounts and allowances, that kind of gives us net purchases, if you will, right? Transfers in are from another department are reported in the same way as purchases from an outside company. Normal shortages like breakage, damage, theft, shrinkage should reduce the retail column because these goods are no longer available for sale. Abnormal shortages, on the other hand, are deducted from both the cost and the retail columns and reported as a special inventory amount or as a loss. And then employee discounts are deducted from the retail column in the same way that sales are. It says these discounts should not be considered in the cost to retail percentage because they do not reflect an overall change in the selling price. Those are all listed on page 463 of your textbook if you wanted to go back and review that as well. In this slide, it's just showing us how some of these things would be dealt with, right? The purchase returns, the abnormal shortage, sales returns, employees discounts, things like that. Again, it's showing us this information like page 464 of our textbook if you want to review that. And then the retail inventory method, again, as we talked about, the reason that companies like to use this is to permit the computation of net income without a physical count of inventory. So we use this in interim periods, right? If we're preparing our financial statements on a monthly basis or a quarterly basis, we use this retail inventory method to estimate the cost of our ending inventory without actually taking a physical count, right? So it is a control measure in determining inventory shortages, regulating quantities of merchandise on hand, and then also for insurance information, we might want to use this retail inventory method. And then presentation of inventories. Hopefully all, at this point, we all know that inventories are an asset account, a current asset account, right? And depending on, whether we use the loss method or the cost method, we want to be consistent in the application of the costing methods. And we do have to include note disclosures, and we'll see some examples of those, explaining the inventory methods used. Significant or unusual financing arrangements should be disclosed related to inventory. If any inventories are pledged as collateral in a loan, or in some other type of way to offset a liability, that should be disclosed. And then whichever basis the inventory is used, whatever method we use to state the inventory accounts and determining the inventory amounts should be disclosed as well. So here's an example of this, showing this is for Mumford of Wyoming, and some of the inventory methods that are used for each of their products. So live, feeder cattle, and feed, they value based on last and first out, which is below approximate market. Live range cattle is valued at the lower of the principally identified cost or market. Live sheep and supplies, lower of FIFO or net realizable value. Dressed meat and byproducts, market less allowances for distribution and selling expenses, right? So it should be disclosed how these are calculated. And then here's another example of how these, especially if we're thinking of a manufacturing company that has not only raw materials, but work in process finished goods. Again, those would all be listed under the current asset section, under the inventory section. And then it just shows us here, note disclosure to the inventories. It says, the first in, first out inventory method is our principal inventory method across all segments. In accordance with generally recognized trade practice, maturing spirits inventories are classified as current assets, although the majority of these inventories ordinarily will not be sold within 1 year due to the duration of the aging process. Inventory provisions are recorded to reduce inventory to the lower of cost or net realizable value for obsolete or slow moving inventory based on assumptions about future demand and marketability of products. So anyway, just gives you an idea of how this information is presented and disclosed of in the company's report, annual report. This would be like, this disclosure is something we would see like in the 10K, the annual report of a company. All right, finally, the last part of this chapter talks about how we can analyze our inventory. And so there's a few different ratios that can be used. Inventory turnover, turnover meaning from the time that we purchase the inventory until the time it's sold, it's turned over. And so if we plug our numbers in here, we're taking cost of goods sold divided by average inventory. Because it says average inventory, we've got to take beginning of the year inventory plus end of the year inventory, divide by 2 to get the average. So 7.53 times per year is what that means. Inventory is turned over approximately 7.5 times per year, essentially. That can also be broke down into days, because we can take 365 days divided by 7.53. And so that's what they're showing you here. So approximately every 48.5 days, our inventory is turned over. Again, turnover meaning from the time we purchase it until the time we sell it. All right, and then here are some of the exercises I have picked out for us to do out of chapter 9. And I look forward to doing these with you in class. Let me stop sharing my screen. Hi there, guys. Okay, so yeah, when we go, next week we will start chapter 9 together, and I will see you then. Bye, guys.